Accounting AS, Chapter 10, Financial Statements of Sole Traders. When we talk about sole traders, these are business that is owned and controlled by individuals. So they also have to make their financial statement. Though they don't have to publish it, but they need to have financial statement because it allows them to keep track of their performance. So because if they are keeping track of their performance, it can allow them to know if they are doing well compared to the previous year. So that's basically why a sole trader might want to keep its financial records. So financial statements are prepared to provide information about the performance of the business and its financial position over a period of time. So we need the financial statement to prepare to just because we do transactions, and these transactions we can't keep track in the mind. We need documents. We need bookkeeping and recording.
Yeah.
So whatever transactions we have with customers, with other suppliers, with government, we keep track of them through recording. That is why we have financial statements. So the financial statement is divided into two. We have the statement of profit or loss and other comprehensive income, which talks about income and expenditure. And we have the statement of financial position, which talks about the assets, liabilities, and capital of the business. So we'll go to the statement of profit or loss and other comprehensive income. Here we have two sections, like I said. We have the trading section and the income and expenses section. So, trading account. Why do we call it trading account? We call it trading account because it records the amount of profit earned from selling the goods the business trades, because the business is selling. So note, for service sector, like the schools, like the insurance company, the banks, they don't sell anything. So it starts with income and expenditure for them. Do you get the point I'm making here? For the trading account, it's basically for those that sell goods, stocks. But when it comes to service sector, they don't sell goods. So it starts with income and expenditure.
Yeah.
I think the point is clear there. So for our trading account, here I wrote, it contains these two sections. We have the revenue earned from sales and the cost of these sales. Revenue is the receipt on whatever goods we sold. The receipt or the amount of money we make from the sales of our goods, that is revenue. Then we have our cost of sales, which are the total amount of money spent to ensure that the product is made available to sell. So it means we would have incurred cost before we finally sell the product. So the cost we incurred, you take it away from the sales of that product, that gives us our gross profit. You get it? So we have revenue, this is the money received from selling goods or services to customers. Then we have revenue returns, because sometimes customers might return the goods we bought.
Yeah.
So if they return it, we call it return inward. So you have to take it away from the sales you have recorded, because if you do not take it away, you will be overstating your revenue.
So you minus the revenue and the revenue inwards.
Returns,
So
revenue returns, yeah.
So you could know how much that you actually made.
Sold.
Yeah.
Because if you do not, you'll be overstating your revenue. Do you understand?
Well,
and if you are overstating your revenue, you would finally overstate your profits. Do you get it?
Yeah.
So that's why it is important for you to understand if you have revenue returns or not. But I think revenue return is understood, right? Yeah. Revenue returns, right? Goods returned by customers. That is revenue returns. Clear?
Returns inwards.
Return inward, yes, thank you. And we have our cost of sales, which represents the total amount spent in ensuring that the goods were sold. I think that is clear. So for the revenue, for the cost of sales, we have purchases, we have open inventory, we have drawings if there is drawing. That means if the owner of the business takes some
Money.
of the goods. No, goods now.
Money of the business.
Money, if it is drawn, that is in the statement of financial position.
Okay,
but if goods are taken, it is part of, you call less drawings of stocks.
Less drawings.
It's part of the statement of profit or loss of that comprehensive income. Then we have our carriage inward. Yeah, I have them here. So items in the cost of sales. We have the opening inventory, which is the inventory that is brought forward to the new year. So the opening inventory is the inventory that you closed with.
Okay.
If this is 2019, so the inventory we closed with in 2018 becomes our opening inventory in 2019.
Okay.
Clear, right? Mm-hmm. Purchases, you had purchases, which is the cost of goods purchased from suppliers, which are meant to be sold. The goods you purchased, you add it to your stock.
Yeah.
Because those are things you are going to finally sell.
Mm-hmm.
So you had purchases. Then you have return outward, which is purchases returns. Those goods that you bought from suppliers that you are returning to the supplier. You have to let this.
So every account you open, like revenue, you have to see if there's revenue inwards.
Revenue returns.
Returns. Purchases outwards.
with purchases returns.
Even returns all of them, yeah.
Yeah, not purchases outward, purchases returns. Or
Outward.
return outward.
Return outward, yeah.
Yeah.
So you got to like check for everything.
Yeah. So if you have return outward, you have to take it away from your purchases.
Okay.
If you have return inward, you have to take it away from your sales.
Perfect.
Is it clear?
Yeah.
Then we have our carriage inwards. These are the amount of money we spend to bring the product into the premises, to convey the product to the premises.
Okay. To sell
Maybe
it.
you bought some goods from Dubai.
You have
Then
to
you have
supply.
the amount you pay on carriage down here is part of your cost of sales. Clear? Then the inventory drawings. If the owner of the business takes some goods from the business, he lets it from the sales, cost
Okay.
of sales. Is it clear?
Yeah, that's it.
I think that's and we have closing inventory, which is the last item in the statement of profit or loss account in the trading account section. So closing inventory is the final inventory that you have that you are about to close with for this year.
In the account.
Do you understand? So
Yes.
you less it from it.
Perfect.
Is it clear?
Yeah.
So this is a format for a trading account. There's a format. Please check that. I have a format. Okay, thank you. So this is the format for the trading account. We have revenue, less revenue returns, our cost of sales, our expense, revenue returns, carriage, opening inventory, closing inventory, cost of sales, and gross profit. So these are it looks like. I think you're gonna get it this way. Okay. Yeah. Thank you. Okay, put that like this. Shall we?
Yeah.
Okay, okay. You can go.
Tamam.
She needs
No,
you.
we can just start. You said that's it.
Okay.
مازلنا. Miss, you want anything?
No. No, ma. Good morning, madam. Good morning, ma.
Orange juice fresh.
Okay, ma. Thank you, ma.
Okay.
Okay.
Yes,
I'll
ma'am.
bring it to you.
Thanks. Shall we?